Just this year, we ran up $341 billion in new debt. And as we discussed the other night, that's our legislators and our president trying to buy our vote this year with what used to be our money. We're not that dumb. Now, where does the money come from? It comes from all these places, and we get $1.1 trillion coming in the door. The two major sources are individual income tax and Social Security and Medicare. Corporate income tax is the third. The others are fairly small. How much money do we spend? We got $1.1 trillion coming in, but we're spending $1.5 trillion. Most of that goes to Social Security, Medicare, and other entitlements. Next to that is national defense, a little over $300 billion. Next to that is interest on the debt. That's unusually low this year because the interest rates are so low, but don't count on that continuing. Can this be fixed? Of course it can. Will it be easy? No. The sooner we start, the sooner we'll finish. But believe me, it will be a whole lot easier than a lot of the things that people did for this great country who came before us. I'll take this challenge anytime, to going west in a covered wagon. I'll take this challenge anytime over the challenge the people had who fought the revolution and gave us our freedom. They had their lives on the line. This is just hard work. If we will do it, if we will team up, if we will make our diversity a strength instead of a weakness, if we will focus on a goal, and if we won't quit until the battle is won, we can pass on the American dream to our children, because we can do anything in this great country. That is the American dream. We can be anything we want to be.
All right. Today is Thursday, the 22nd of May. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Now, I read some of your comments and your feedback, folks, and some of you are not happy that we're talking about the budget bill too much. Trust me, I'd rather talk about something else. But why is it so important right now? Because usually the stock market, the economy, doesn't really care about the budget bill so much. So what's different right now? What's different is we have the bond market, not just in the US, but globally, saying no more debt. We cannot handle it anymore. And so long as we have interest rates going higher, as debt increases, in the past, we haven't seen that. We've increased debt, interest rates went down. But now as we increase debt, interest rates go higher. What are the consequences of interest rates going higher? Let's start with the economy, then the market. In the economy, it reduces consumer spending because it costs more for you to use your credit card. It's going to be more expensive for you to get an auto loan. It's going to be expensive for you to get a mortgage rate. And that's recessionary by nature, slowing down the consumption in the economy. Furthermore, it slows down the pace of lending in the economy. So you're going to see less and less expansion in the economy, and you're going to see the GDP diminishing. Now, the impact in the market when you have interest rates higher and fixed income, at some point the risk versus reward in holding the stock market doesn't make sense anymore. Because if investors can net 5% plus in interest rates risk-free in using fixed income, what is the point of taking risk in the stock market? A lot of investors, specifically older investors, closer to the retirement age, will begin to migrate out of the stock market. Not to mention, of course, foreigners will do the same because their own bonds will begin to pay more than what the U.S. stock market can provide for them. How did we get to this point? We got to this point because our sugar daddy, the Japanese, they need a sugar daddy now because they have a bond crisis of their own. So they have to dump our bonds to buy their own bonds, and they can no longer participate in buying U.S. bonds, at least at the same pace they used to in the past. Likewise, China is divesting away from the U.S. China is no longer paying for our debt and for our wars. And hence, as the auction yesterday illustrated, weaker demand will only be resolved by higher interest rates. You have to offer higher and higher interest rates to attract buyers. The other thing, of course, remember what I said about higher interest rates and the negative impact on the economy. Slowdown of lending in the economy, a slowdown of consumption in the economy. It's the bond market's natural way to remedy the inflationary impact of higher debt by increasing the rates. If Congress is not going to do any discipline, the bond market will do the discipline for us, and it ain't going to look pretty. So this is why we're talking about the budget bill, folks. We're probably going to be talking about it all summer, to be honest with you, because Let's dive in the commentary right here. Overnight, of course, they had an all-nighter session in Congress, and the bill passed the House. It passed by one vote. The other vote, of course, this congressman was asleep, so he did not vote. Now, of course, this congressman is from New York, and had he voted yes on this bill, of course, he would have gotten killed, because the SALT tax deduction, which anybody who lives in New York, even if you're a Republican, Democrat, doesn't matter, you're going to be taxed to death now. So he took the easy way not to upset his own party leadership and not to upset his constituencies too. So he decided to fall asleep. Of course, we had two congressmen from the Republican Party voting no in the bill. Of course, no surprise, Thomas Massie is one of them. And he said, here's a sign of what's in store if the big, beautiful bill passes. He was commenting about the auction results yesterday. Congress can do fantasy math, but when investors put money on the line, the math gets real. Bond markets are already demanding higher returns because Congress is not serious. The Fed no longer controls rates. And that's the most important point, by the way, because in the past, we've resolved the same problem by the Fed controlling rates. Now the Fed does not control rates anymore. The Fed already cut rates by a bunch last year, and interest rates went higher in the longer end of the yield curve. So more cuts will just push the rate higher. We have gone to the point of no return, folks, as I said repeatedly in this program. Here's another take by Peter Schiff. He says the big, beautiful bill contains 1,116 pages, yet not a single page reduces future deficit. In fact, they make them larger. Only two House Republicans had the courage to vote against this monstrosity. Thomas Massie and, of course, Republican Davidson. The bill is a total fraud and a betrayal. And I say amen. That's the reality. And just a reminder of the flip-flopping by the GOP. Last year, when Biden was president, here's what Speaker Johnson said about the deficit. Take a look.
The number one threat to our nation right now is our debt. It's not China, Russia, Iran, or North Korea. It's the debt.
Well, now all of a sudden he doesn't care. What the GOP has done, folks, is abandoning conservatism, abandoning fiscal responsibility. And there will be massive ramifications to all of this. Remember what I'm saying right now, because for sure, with 100% degree certainty, the Republicans will lose the House and the Senate next year. And assuming Trump is going to finish his term, the next president will probably be Newsom. And now we have a vacuum. Why would the Republican lose? Because they've created a vacuum. A lot of folks who supported the GOP because of fiscal conservatism are now looking for a new home. And this is why I'm betting on a new movement that will mirror what we've seen in the 90s with Ross Perot. Anyhow, I said this is really important for all investors to understand, because a lot of folks say, yeah, but the stock market is back in the green, Maverick. What are you talking about? No. Are you really that big of a moron not to understand this? The value of the US dollar went down year to date by almost 10%. So whatever you got in the stock market right now, shave 10% because the value of the dollar went down. And I said here in the old days when the US dollar value dropped, stocks moved up to compensate for the loss in dollar value for investors. Now we are heading to a new era where both the US dollar and stocks head down together. Double whammy for investors, because if you lose 5% of the S&P 500, then you lose another 10 in the dollar, you're down 15% at least. And how would that compete with, let's say, 5, 6, 7% interest rate and yield on pretty much a risk-free bill or a risk-free note that you can hold in fixed income? That's not a good outcome for the stock market, folks. On top of that, when we talk about the deficit and the reasons behind interest rates going higher, check out what we got today in the PMIs. This is really important. When it comes to the price index, in the flash PMI, average prices charged for goods and services jumped higher in May, rising at a rate not witnessed since August 2022. That's the height of the inflation problem that we got. If you recall, that's when Jackson Hole Jerome Powell came out and said there will be pain. So we're back to the same pace of inflation increasing rapidly. And this is why Jay Powell is not going to cut rates anytime soon. He's going to be too afraid to do so. But he's going to face more and more political pressure by the president. This is what the summer is going to be all about. The debate about the bill and the debt ceiling and the fight between Trump and Powell. And it's going to get ugly, folks. At some point, it's going to get really, really ugly. And the market is going to freak out. Now that the House passed the bill, it goes to the Senate. And of course, the Senate will have to do their own surgeries on the bill and carve things out and add things in. Now, the Republicans hold 53 seats, Democrats 47, along with the independents who ally with the Democrats. We're talking about Bernie Sanders and Senator King. You need a simple majority to pass the bill, so you need 51 votes, meaning that the GOP can afford to lose only 2 senators to pass this bill. If they lose more than 2, then they have to flip a Democrat. Now, who are the 3 members of the Senate right now on the Republican side who are holdouts, who are hard no right now? They're going to vote no on this bill that passed the House. You got 3 gentlemen here. Of course, we have Rand Paul, and we have from Missouri, Josh Hawley, and then we have from Wisconsin, Ron Johnson. Let's hear one by one what their concerns are, beginning with Rand Paul. Take a look.
Who's got questions?
So what do you make of the House reconciliation bill that just passed? Can you tell us your thoughts, and would you be willing to support it unless there are changes?
The House bill is going to add about $4 trillion to the debt ceiling. The Senate bill adds $5 trillion. There's nothing fiscally conservative about expanding the debt ceiling more than we've ever done it before. This will be the greatest increase in the debt ceiling ever, and GOP owns this now. The deficit this year will be $2.2 trillion. The GOP owns that now too. But if you borrow $5 trillion and you have a $2.2 trillion deficit this year, it means you're anticipating a $2.8 trillion deficit next year. There's just nothing conservative about borrowing $2 trillion a year. People are lost in this. I'm like, how much are the cuts? 800 billion to 1.5 trillion. No, what matters is how much comes in and how much goes out. What is the net? Is it positive or negative? And borrowing this money just isn't fiscally conservative.
So Rand Paul's problem is the deficit. In other words, he wants to reduce the deficit. He doesn't care where that's going to come from. Cutting more Medicaid, cutting more benefits, doesn't matter. So long as they reduce the deficit, he's okay with that. And what about Wisconsin Senator Ron Johnson? What is his problem with this bill? Take a look.
Op-ed out in the Wall Street Journal. We see the headline there, the ugly truth about the big, beautiful bill. What's beautiful, Senator, as you see it, and what makes you cover your eyes?
Well, this is my 3rd column in a series of 3, where I've been pointing out since the first of the year that we need to return to a reasonable pre-pandemic level spending. And I laid out the options. I think this was an extraordinary event, the pandemic. We went from $4.4 trillion in spending to $7 trillion this year. That's a 58% increase. There's no justification for that. So we have to return to a reasonable pre-pandemic level. I've laid out options somewhere between $5.5 and at most $6.5 trillion, which would imply a whole lot more savings than the meager $1.5 trillion over 10 years, $150 billion at most. By the way, and then we're increasing spending by $342 billion over 4 years. So again, the savings we're talking about in relationship to the $89 trillion we'll be spending over the next 10 years, it's barely a rounding error.
I heard you just describe it as meager.
It is meager, but at a minimum, we shouldn't be increasing the deficit. And I don't see any scenario that they're discussing right now where we don't actually increase the deficit over 10 years with this big, beautiful bill. So again, I'm all in favor of certainly giving tax relief to middle-income Americans, making sure we don't have an automatic tax increase, providing border funding. But I've always been in favor of a 3-step process so we can spend a lot more time on the tax provisions and making sure that we get this type of spending reductions in order to return to a reasonable pre-pandemic level.
Are you disappointed?
So we have both Rand Paul and Johnson. Their main concern is the fiscal deficit. And to be honest with you, I don't know how much can we cut in Medicaid to have a surplus instead. It's almost impossible to just do it via the cuts alone. Maybe they're going to settle down at a smaller deficit and tout that as an achievement. Hey, the deficit was 3.2 trillion. We moved it down to 2.2 trillion, 2.5 trillion, 1.8 trillion, whatever number they settle at. And that's going to take a lot of cuts to Medicaid, besides the cuts that we already have. Now, who has a problem with the bill because of Medicaid? It's Hawley from Missouri. Take a look.
Republican Senator Josh Hawley, who represents Missouri, a state where roughly 1 in 5 people are on Medicaid, he wrote a New York Times op-ed this week with a very simple message: don't cut Medicaid. Senator Hawley joins me live now from Capitol Hill. Senator Hawley, thank you so much for being with me this afternoon. So as we just showed you, you were warning your party not to cut Medicaid. The speaker, though, he just said this about the House GOP's so-called big, beautiful bill. Listen.
We'll cut Medicaid.
We're not cutting Medicaid. Stop buying that.
So he said, if you heard there, Senator Hawley said, we are not cutting Medicaid. Do you agree with the speaker? Is this bill not a cut to Medicaid?
Well, the right thing to do is not to cut Medicaid, so I'm glad to hear him say that. Manu, it ought to be just a basic foundational principle. It is wrong to cut health care for the working poor, and that's what we're talking about here with Medicaid. My state is a Medicaid expansion state. Over 20% of Missourians, including hundreds of thousands of children, are on Medicaid. And Manu, they're not on Medicaid because they want to be. They're on Medicaid because they cannot afford health insurance in the private market. These are working people and their children who need health care. And it's just wrong to go and cut their health care when they're trying to make ends meet, trying to help their kids, trying to make sure that they're able to provide for their families. So I hope that the House GOP and the Senate GOP will get the message.
So at the end of the day, I think they're going to reduce the deficit by a little bit by cutting more Medicaid. And maybe Josh Hawley is going to be a holdout and say, no, doesn't matter. The bill is going to pass. If you got Paul and Johnson, maybe he doesn't want to be allying with the Democrats. So he's going to vote yes anyways, if he's the only holdout. In other words, they're going to cut your Medicaid dramatically. Now with that, of course, there's another loophole that if you cut Medicaid, soon enough it's going to be Medicare. But anyhow, all of these cuts to Medicaid, what do you think that's going to do to the healthcare sector in the stock market? If you think that we've seen pain already in United Health and the insurers, we're going to see more pain. We're going to see it in the diagnostics and the medical devices and more in some of the insurance companies and perhaps the big pharmaceutical companies because spending will be less. Now, you can argue this is good, this is bad. I'm just illustrating for you the impact that this is going to have in the stock market. And if there is no significant decrease in the deficit, well, guess what's going to happen? Interest rates will continue to go higher. And as we debate the bill throughout the summer, every decision will impact interest rates. And if they move it higher, that's going to be problematic for the stock market because right now we cannot handle the 10-year yield above 4.5. I told you guys that before. 10-year over 4.5 is a problem. You're not going to be able to rally the stock market. The 30-year above 5%, you're not going to be able to rally the stock market. Go above 5 in the 30 and above 4.5 in the 10, and equities will begin to flush down dramatically. Of course, the administration right now thinks that they can manipulate their way out of this. And I'm illustrating for you here using the TLT 5 minutes chart. You can see that overnight we see these gap downs, meaning that the foreigners are dumping our bonds. But then there's a mysterious buyer that hops in the morning and rescues the day. So maybe Scott Bessent is manipulating the market right now by buying bonds, which, by the way, increases the debt even more because we are borrowing more money to buy our own bonds. We've reached the point of no return here, folks. When you max the credit card and you have no other resources and your lender says no more, well, you're going to have to file for bankruptcy. You're going to have to face the music. But of course, the White House will shift the fight. This is really important for us to understand because this summer is going to be hot. It ain't going to be, oh, we went to Europe and we're enjoying cruises and slurping and champagne and the market is just floating higher. Because the president is going to be frustrated. And he's going to say, why isn't Jerome Powell cutting rates? He's going to add so much pressure on Jay Powell to cut rates. And he doesn't understand that if Jay Powell cuts rates, you're going to see the 10-year yield all the way to 30 moving higher, not lower. Maybe you'll see the shorter end of the yield curve, the bills, the notes moving down, but not the important bonds that impact interest rates in the economy. And this is why the decision that we got today by the Supreme Court is really important. So they say that Trump can fire whoever he wants, but he can't do the same with Federal Reserve members. In other words, the Supreme Court is saying, hey, Trump, you got to be careful. Don't fire Powell. That's going to be a big constitutional problem, and we might side with Powell over you. And Powell threatened that he's going to go to court if he's fired. So what would be the alternative by the president if he cannot fire Powell or twist his hands to decrease interest rates? The other alternative would be to reduce the deficit, he needs to bring back the tariffs. And I'm not talking about 10% or 30%. I'm talking 50 plus on every country that we do business with, especially China, to raise the revenue needed to plug the deficit, at least some of it. And we've already seen what happens to the market when tariffs are discussed. The market goes down and we amplify the chances of stagflation in the economy. Folks, I'm trying to brainstorm an exit here. I'm trying to brainstorm a positive outcome out of all of this. What is the solution here? And there is not one good answer. all of the solutions are bad. I don't think that investors really grasp in the market, they don't grasp the gravity of the situation right now. And this is why when Jamie Dimon came out earlier in the week and said we have complacency in the market, I do agree with that, because investors are not really thinking about all of that stuff. And they even dismiss all of these risks. They say that, oh, Moody downgrade doesn't matter. Oh, the bond auction doesn't matter, until it did. And there's more where that came from. Anyhow, folks, let's segue to the market information and add more color to this conversation. We begin with the closing of the indices, and here we go. The diamonds closing in the red, be it flattish, down 1.35 points, or pretty much flat for the day. Not a massive loss. We've seen the dip being bought in the morning, but then they flushed it down at the end, which is different behavior than what we've seen the last few days, few weeks. We see the mysterious buying volume showing up at the end. Today, we've seen selling volume. That's a different message, and we have to pay extra attention to that. You got the NASDAQ in the green, though, 53.09 points, or a gain of 0.28%. The S&P negative, beat flattish, down 2.60 points, or a loss of 0.04%. The Russell 2000 negative, beat flattish, so again, today it was pretty much a nothing burger kind of day. It's sort of the let's absorb the shock from yesterday's auction, and let's digest this a little more. We might do more digestion, by the way, because we have a long holiday weekend. We do have Memorial Day coming out Monday. So the market might decide to sell a little bit more in tomorrow's session and then decide what they want to do next week as we digest more what happened this week. Looking at these sectors, the market was attempting to do a risk-on rotation. It didn't succeed much. We see cyclical technology, comm services leading the pack. We see defensives, risk-off like utilities, healthcare, defensives, energy, leading the way to the downside. Utilities, of course, impacted by the big, beautiful bill, cutting a lot of clean energy, quote-unquote, spending. So you saw names like NextEra Energy, which is the biggest weight in the XLU utilities, the sector, going down big. And that impacted, of course, the loss, the magnitude of the loss that you see right here in the utilities. Looking at the breadth, pretty much close to neutral, as the market maker loves to see. I mean, day after day after day, the market maker keeps winning. Why? Because go look at the calls. Go look at the puts. 0 DTEs in the NASDAQ, in the SPY. All of them lose value. If you hold any options, short-term options, the likelihood right now you lose in the following day because the market maker keeps it neutral. Makes one move, sucks everybody in, short-term traders who buy 0 DTEs, weekly expirations, and then shove a big massive pie in the face to these short-term traders. So you have to be careful here because the market maker is playing a really nasty game day after day after day. They're keeping the breadth neutral. So the NYC, 41% advancing, 56% declining, close enough to 50-50. NASDAQ, close enough to 50-50, even more than the NYC, 47% advancing, 50% declining. Looking at the heat map, what do we see here? A little bit of an attempt for a rebound across the board, but you can see that the majority of the gains are concentrated in the big caps. So you have Amazon, Google, Microsoft, NVIDIA. Apple, of course, has its own problems, but Tesla participated today. And there is a theory behind that. More on that in a minute, but who are the losers? The defensive, the risk-off kind of stuff. The staples, the utilities, the real estate, the healthcare names, all down big. So what if now the rates are going higher? This is really important for everybody. What if rates going higher makes dividend stocks not as attractive? The majority of the stagflation portfolio, aka the risk-off stuff in the stock market, is dividend paying. If you have a stock that pays 3.5, then you have a fixed income that pays more than 4. What is the point in holding the dividend at that point? So we need to hedge here, folks, especially if you have a lot of dividend paying stocks in your portfolio. You need to hedge. And you can do that via shorting one of the dividend ETFs. You can do DVY, for example. It looks to me that it is forming a series of lower highs and maybe soon enough lower lows. Or you have the Charles Schwab, which was the outperformer in the beginning of the year. But now with interest rates on bonds going higher, there's no need for dividends anymore. So we see a big flush down in the Charles Schwab dividend equity ETF, perhaps forming a bear flag pattern. So if you have a lot of healthcare, a lot of staples, a lot of dividend paying stocks in your portfolio, you gotta have a hedging plan right now. Don't say, Mav, you said buy dividend stocks and stagflation portfolio and now they're down. You gotta hedge because this market is gonna move so fast. You're gonna float like a butterfly, sting like a bee. Otherwise, you'll be caught with your pants down. Things will be good for a few weeks, few months, and then they become ugly. And we have to adapt. Now, the only stocks that do pretty good in, let's say, higher interest rates environment, it's not the banks, believe it or not, because the banks, yes, they do more interest income. But the problem is they have less loan generation because of higher rates. So net, they lose money. The companies that do pretty good in higher interest rates are the companies with a lot of cash. And this is why you see the big caps like Microsoft. Microsoft has a lot of cash. The NVIDIA has a lot of cash. So maybe today the attempt in moving the market higher was based on that. Hey, which company has more cash and can withstand higher interest rates? Keep that in mind. It's just a theme for now, but I don't think it's going to sustain because at the end of the day, even holding Microsoft, NVIDIA, all of these names at these valuations and the risks that we have in the economy doesn't make sense anymore. Looking at the heat map for the ETFs, TLT got a rebound today, but it did not help pretty much. You see modest gains in large cap growth. That's your Microsofts, your NVIDIA, your Google, your Apple. But value was down, mid caps down, small caps flattish, nothing worked out. And even, by the way, gold pulled back today, gold miners, GLD gold pulling back. The only thing that worked out today besides the TLT is cryptos, Bitcoin now acting as an alternative to the dollar. And the more worries we have about the fiscal outcome, the higher Bitcoin goes, along with gold. And we have the XRT, but that's tilted because of earnings that we got from certain companies. Moving on to commodities, we see oil down across the board, nat gas with a big flush, and we warned about that. Got to be careful because it is forming a topping and a shoulder in the weekly. So hopefully you guys who are long nat gas already hedged. We see declines also in cocoa, coffee, sugar because the dollar rebounded by a little bit. But OJ is oversold too much, so we see OJ with gains of about 5.5%. Now I would see the dips in metals and in softs as an opportunity to buy because I'm betting on the dollar to continue to decline. So when you see dips in sugar, coffee, cocoa, you probably want to buy those. When you see dips in palladium, copper, platinum, silver, gold, you probably want to buy those. And then you have in grains, wheat, corn, any pullback, probably buyable. We're going to look at some of these charts, by the way, for commodities in the charts analysis in a minute. Moving on to the big casino options, what do we see here? The volume is shy and concentrated on three names, NVIDIA, Tesla, Alphabet, because we have some hedge fund managers probably buying Google at this point, and we see the traders following through with buying calls, but it pops in the morning big, up 3%, then it goes down and closes with a modest gain. The bias remains for calls. Now we're seeing 70s, 80s, so we still have excessiveness happening here in calls versus puts, meaning there is no fear yet in the market. You look at the IV ranks, they're attractive, some of them beginning to move higher out of the 20s into the 30s, so the cost of hedging is getting a little bit more expensive as the VIX begins to trade above 20. Therefore, you want to hedge your portfolio, you got to do it right now. When you look at the IV percentile, what stands, of course, is you have QBTS at 81. A lot of you asked about this in the stream today, in Discord today, and I said, look, when you see a name like QBTS or CRWV shooting up significantly higher, it is not in your advantage to buy calls or puts because the market maker already priced the premiums way too expensive for both names, QBTS and CRWV. Even if you're betting on a put that, okay, we topped, we're going to go down, the market maker is already pricing in a drop of about 20% in CRWV. So even though you got 6 to 7% today, you lost if you bought the puts. You didn't make money because as the name goes down, the implied volatility is reduced. So it works against you. And therefore, I said in the stream and in Discord repeatedly, when you see a phenomenon like we've seen in CRWV and now in QBTS, in many other quantum computing stocks, what you want to do is either you buy the stock if you're lucky enough to catch the move before it happens. You buy the stock and then you sell covered calls, or you sell naked calls or naked puts. But in the case of CRWV, of course, we sold, at least I did, the naked calls. A word of caution, folks. When I do these kind of moves, I know what I'm doing. I have experience in doing that. I know what my risk is. But I'm begging you, please don't follow me without knowing what you're doing. Because if you sell the 120 calls, yeah, going to raise a huge amount of money. I said it's easy money. But the problem is it comes with huge risk that if CRWV continues to go higher, you could blow up your entire account. The margin requirement would be too high, and any movement to the upside can blow up your account. So please do not sell naked calls or puts until you know what you're doing. And the best way to know what you're doing is to begin by selling credit spreads, puts or calls. Once you master that, then you can graduate to selling naked calls and naked puts and play market maker. Let's do the unusual activities, beginning with IBIT. This is the iShares Bitcoin ETF. Bitcoin is going higher. Somebody's betting on more gains to come. Trading right now is 63, but they bought the 75 calls. So big move coming is what they're betting on. 75 calls. The expiration date is June 20, 2025. Spending about a little over $1.5 million. Then we have RGTI, Rigetti Computing. That goes with the quantum computing stocks, which are heating right now. And somebody sees a bigger pop to come. The stock right now is trading at about 13, 14 bucks. The trader is betting on 16. They bought the 16 calls by the expiration date of September 19th. Spending a little over $1.25 million. And to be honest with you, they're betting that Rigetti is going to pop all the way to 20 and above for the trade to be profitable. Now, when I look at Rigetti, weekly chart, it looks to me that it's readying for a core weave kind of move. Maybe it's going to go challenge the highs again at about 20. So I would follow this trade as a speculative bet here on Rigetti Computing. On to the bearish trades. This comes hand in hand with the diagonal bearish spread that we've seen on NVIDIA yesterday. And there is a message. You got to pay attention now. What they're doing is a reverse calendar call spread. They're selling the 138 calls for the expiration date of next week. They're buying the 138 calls with the expiration date of tomorrow. What is the bet here? The bet is that NVIDIA, when it reports earnings, it's not going to go higher. It's either going to stay flat or head down. So why not exploit that and raise a credit of about a little over $1.5 million? But if it pops in tomorrow's session, for example, you got your hedge at the 138 with the expiration date of tomorrow. I think there's a cohort of traders right now, based on the trade that I'm seeing right now and the trade that we've seen yesterday, betting that NVIDIA will probably head down, not up, when the report comes out next week. And then we have GILD. And this is for Gilead, and again, healthcare is having its own problems, cuts to Medicaid, and this one, of course, is more in the HIV drugs, which the administration is trying to cut. So it could be on the chopping block here, and this is why somebody bought the 100 puts. The expiration date, June 20, 2025. Spending about a little over $1 million. Now, if you've been a shareholder of GILD, I would say maybe you want to do this trade if we lose the 50 days moving average in blue, which is sitting right now about 105.81. If that happens, yeah, I'll follow the trade as a hedge. But right now, it looks to me that it's just consolidating, maybe pulling back a little bit, readying for another move higher. And the last one I got for you is for HIMS, HIMS. Been on fire, and we caught it before it popped, by the way. Go back a few videos ago, we talked about the cup and handle pattern. Buy HIMS as your rebound play, and HIMS exploded significantly higher. But now, the tide is shifting for HIMS, and somebody bought the 55 puts, the expiration date August 15, 2025, spending about a little over $3 million. You look at HIMS, notice that little tiny cup and handle right now, which we said, hey, you got to buy HIMS because it's going to pop. Well, it did pop big now. But if you look at the momentum in the MACD indicator, it's rolling over, as it did in the previous stop. So right now, I think that HIMS is going to flush down all the way to the 50 days moving average. So the trade right now, if you want to follow it, 55 puts, expiration date August 15th, a little pricey, so you can play your own games here. It's a high beta name, but understand that you're going to overpay for the puts, so you probably want to do it via spreads. Maybe you want to buy the 50, sell the 40. I think that's the trade that I'm going to do. Moving on to the charts, and we begin with the E-mini futures 4 hours chart. What do we see here? We're losing the trend line a little bit, maybe forming a bear flag pattern. I think the target is 5,800. We need to revisit 58, see how it's going to hold. And the equivalent of 58 would be in the SPY about 577. I think it's only reasonable to go retest these levels and see how we do. If we look at the daily chart for the E-mini futures, of course, in tomorrow's session, the most important thing is, can we close above or below the 200 days moving average in orange? Either way, folks, you look at the MACD indicator, it is rolling over. So we're now entering a corrective phase, which means we're going to pull back. We're going to retrace some of these gains, maybe 58, 57, 56, maybe more. It's a step-by-step process. You can't bet on a crash right away every time the market pulls back. You gotta take it one step, one increment at a time. Looking at the NASDAQ futures above the 200, but it doesn't matter. The number here is 21,000. If the E-mini futures begins to go down and closes below the 200 days moving average by tomorrow, then I think that the NASDAQ futures will be below 21,000. That's going to be your permission to begin buying the 20,000 puts all the way June, July expiration. maybe you want to sell the 19,000 on it just to reduce the cost a little bit. We'll talk about that in Discord tomorrow if we see the opportunity. And then we have the leading indicator, the RTY Russell 2000 futures. This one abandoned the bull flag pattern, now forming a bear flag pattern. And you see the momentum in the MACD indicator is rolling over from bullish to bearish. I think at least we go down to the 50 days moving average, and this is why I think that if you buy the 2000 naked call with the expiration date of June or July, that's going to be a good trade. And as it goes down, maybe you can expand it by selling a 1900 puts, for example, as a debit spread, or maybe you can do diagonal or calendar spreads. You can have a lot of options, but right now my trade would be the 2000 puts on the RTY. Some of the indicators, we got the dollar been declining here. I think it's going to retest the lows and break the lows. Look at the momentum, the MACD indicator is probably going to roll over from bullish to bearish. So I expect more declines to come in the dollar. As I said in yesterday's session, or yesterday's video rather, I said you can play the decline in the dollar by buying the Japanese yen and the Swissy. You can also buy the old man, because the old man is maybe retreating right now, just consolidating a little bit. It's above the 50, it's consolidating the bull flag. I believe if the dollar goes down, we'll see more gains to come in gold. Bitcoin, by the way, doing the same thing. Every time the dollar goes down, we see Bitcoin going higher. Copper, we're looking at copper futures right here. I would stick to the bullish call. I think we break higher. We're going to go back to 5 in copper as the dollar continues to decline. Palladium, same thing. Gave you a pullback today, but the saucer bottom is still intact. I think we have a breakout in ABC pattern. So all of the metals, the pullbacks are buying opportunities if you believe and agree with me that the dollar is heading down. You look at crude oil, rejection of 64, didn't make it to the 50 days moving average, not looking pretty here because it mimics the dollar. I know that we have geopolitical concerns and maybe over the weekend we'll see Israel striking Iran and we see a big problem, but the best way to play it, to be honest with you, because unless you have the timing correctly here, unless you're in the Mossad, please share the information with us if you happen to be in the Mossad, but unless you have the exact date of the strike, you can't really time it pretty good here. And if we see the dollar continuing to go down, you will see crude also heading down with it. So the best bet right now on a geopolitical flare-up would be the defense contractors. Specifically, we talked about this in the stream yesterday, LHX, Harris. Look at the weekly chart right here. It is beginning to gather a lot of bullish momentum. It is pushing its way to expand those Bollinger Bands higher. So I think the best bet, if we have any flare-up in the geopolitics over the long weekend, I think buying LHX will probably be your best bet and better than crude oil, because if nothing happened over the weekend, you still got a really good stock that you can own. Another important indicator is the 30-year bond yield. We're above 5%. Let's see if we close the week above 5 or not. The previous high was 5.178 basis points. If we close above by tomorrow's session, oh boy. Yeah, it's going to rattle investors. Everybody's going to sell and hedge before the long weekend, because if we close at a new high, it's going to be problematic here, folks. So mark that number in your charts. If we close above, appears to be closing above, you will see the hedging happening beforehand. And of course, as rates go higher, is that good or bad for the home builders XHP? It is bad, and we suggested that we have in the weekly chart an inverse ABC pattern that would lead us all the way down to the 200 weeks moving average. So we continue to be bearish here against the XHP so long as rates go higher. What else can be a casualty of rates going higher? How about the ticker DESK, DESK? This is the ETF for commercial and office real estate, which is the weakest segment in real estate. Some of you want to short the IYR, for example, but I think it's better if you short DESK, because these are the ones that are going to be really, really sensitive to higher interest rates. You're not going to be able to do it via options, to be honest with you, so you got to short the index right here. I think it's going to make an inverse ABC pattern. And by the way, the weakest bank that has exposure to office and commercial real estate, that's going to be Wells Fargo. And you could also short the IWM, Russell 2000, RTY, or the IWM. If rates go higher, the IWM will continue to head down. And I think it heads down all the way to the 50 days moving average that you see in blue. So my trade, as I shared with you today in Discord, is buying the 200 puts for June and then selling the 190. You can sell the 195 if you'd like, and then roll it down to the 195, 190 put debit spread if it works out, and if we break the 50. But I'm just going to go with the 200, 190. I think that's the trade that I like. If we go down to the 50, the trade is going to be profitable. If we go beyond the 50, then the trade will be even more profitable. The other indicator is the VIX. Look at the MACD daily chart. It looks like it's going to begin to pop higher again. We're shifting from bearish momentum toward bullish momentum. We're closing above 20. Really critical to see if the VIX is going to close the week before the long holiday weekend above or below the 20. My hunch is it's going to be above, and that's going to initiate the process of the VIX banking another leg higher. And that means that the corrective phase in the market will continue as we head to next week. So let's look at some of the big names that could be impacted by a VIX moving higher. How about Apple? Apple lost the 50 days moving average in blue. It is breaking down from the rising wedge pattern. I think we have a retest of 196.5. If we lose that, then we could talk about lower targets at the 180s, but one step at a time. How about NVIDIA? I think NVIDIA is going to hold ground right now. Nobody wants to short. Nobody wants to buy before the report comes out next week. So NVIDIA is going to hold strong. If we have a big pop in the VIX, a freak out, an algorithmic kind of selling, as we've seen after the auction, sure, NVIDIA will be sold off a little bit, but if you want to bet bearish or bullish, folks, avoid NVIDIA because it's going to be stuck here all the way till the report comes out. Souffle Tesla, 2 hours chart, what do we see here? Moving higher today based on the robo-taxi promise that we're going to have some in Austin, and then we're going to add hundreds of thousands, as Elon Musk says, hundreds of thousands of robo-taxis by 2026. Now, when Elon Musk says 2026, it's going to be 2036. And don't forget about Waymo, which is already way ahead of the game. Sure, Tesla has the data, got it, but they don't have the real-life experience as Waymo. So I think they're going to run into problems, going to hear about crashes and glitches. And either way, look at the technicals right here. We haven't reclaimed the trend line. I think it heads down in perhaps an inverse ABC pattern. So we're going to stick to the 320 calendar puts. Of course, in tomorrow's session, if you followed my trade, you're probably going to have the 320 that we sold for this week expiring worthless. And what you want to do is buy it back before the close, and you want to sell the 300 puts or the 310 puts for the expiration date of next week to balance the trade. And you're probably going to create a profit without the trade even working out. One step at a time, I'm going to guide you in this card. Lastly, BTC looking beautiful here, breakout from the bull flag above all of the important numbers. And as the dollar goes down, folks are chasing Bitcoin right now. I think it has an important test coming out if the big caps begin to crash, which we haven't seen yet. In the meantime, folks are treating Bitcoin as a hedge against the dollar and the deficit and the fiasco that we're seeing in DC right now. Moving on to the conclusion of this video, what do we have in the economic calendar tomorrow? Bunch of Fed zombies talking, from Kansas City president to St. Louis president to Governor Cook. And then we have new home sales. The housing data is coming out ugly, ugly, ugly. So new home sales is probably going to be disappointing, and they're probably going to push the XHB even lower. Do we have anything in the earnings calendar tomorrow? No, not anything important. But next week, we have the big kahuna. We have NVIDIA, we have Costco, we have Salesforce, we have Dell, we have Marvell, Lululemon. We have, if we scroll down, we have Okta, we have Ulta Beauty. So it's going to be an important earnings week too. With that, folks, this is all I got for you for tonight. Thank you for joining us. Thank you for listening. Thank you for watching. I appreciate and love all of you. We'll be talking again to some of you tomorrow in the live stream, and then we're going to talk again over the weekend. I'm going to produce some bonus videos for you, so we're going to have a lot of material to cover in the long holiday week. Until then, folks, take care, have a great long weekend, and happy Memorial Day. Good night.